Good evening, ladies and gentlemen. Welcome back to Walk the Block Navigating Digital Finance. This is our special episode, aka Profit Taking 101 in Crypto. I'm your host, Zenith, and I'm joined by my excellent co-host tonight, Tracker. How you doing, buddy?
Doing good, man. This is going to be fun. This is kind of something that I think people have on their minds because some people are feeling like this is the time to start taking profits. Maybe not others are thinking the same thing. To each their own, but you still got to have an exit strategy. So this is going to be good stuff to cover.
Sir, and just as a heads up for folks tonight, we're going to talk about why are we even taking profits? And then we're going to do a quick math analysis on a few different or two specifically different strategies on how to take profits and show why you might want to use one strategy over the other. Again, nothing we say on this channel is financial advice. You got to make that decision for yourself. But what we're doing tonight are breaking down some of the strategies so that you can decide for yourself what kind of investor you are and which of these strategies kind of appeals to you. And we're going to give pros and cons to everything here. But outside of that being said, this is definitely in our Crypto 101 side of the wheelhouse. So tonight on stream on YouTube, we're going to be breaking down exactly what I talked about. And then afterwards, we're going to give a special shout out to all of our Telegram private members, and we're going to take the stream over there. So once we're done here, hop on over the Telegram, we'll fire it up there, and we're going to cover even more indicators and strategies. And specifically, we're going to be looking at top indicators, and then we're going to be looking at even more profit-taking strategies for other options. With that being said, good sir, let's get into this. All right, here we go, folks. Profit taking 101. Tracker, why would anyone want to take profits when they're investments? Is this different than your 401k? Would you just kind of like set and forget and wait until you can take out when you're 65?
Well, regardless if it's 401k, I think that comes down to how active are you with your investments. Are you somebody who just in a 401k throws all your money at your money manager fund or your brokerage fund and say, here, you figure it out. I'm just going to pay you and not have to worry about it. If you have that luxury, that's great. But they have a strategy, certainly. So for people that are very proactive to this, there is times you want to be taking profits out of the markets and times when you want to be putting more money in. The rule of thumb is typically when everyone's euphoric. I know we're going to get over the psychology here later, but when everybody feels like it's just nothing but up from here, there's nothing wrong. That's probably at the best time to say ultimate quote when there's blood in the streets and everyone thinks the end of the world's coming to an end. That's the time to start, basically buying when things are at suppressed levels. So being the contrarian basically is a concept that a lot of people just can't seem to wrap their heads around, because normally when everyone's FOMOing and everything's going great, you want to add to it. But then when things are going bad, you're thinking, oh, I got to get out of the market. And unfortunately, it's the other way around.
Agreed. And the overall theory behind taking profits is that you are going to get more return out of your investment if you're able to buy low and sell high and then rebuy in once prices are low again. For the 401k analogy that I mentioned, that's something which is just like, it's operating off the theory that the S&P 500 or the US stock market, if you will, is pretty much just going to go up into the right forever and is never really going to have major corrections that you can count on. So just keep throwing in money on a weekly, monthly, bi-monthly paycheck basis or whatever. And that should, through the magic of compounding interest, really help you out there. The difference between that and what we're talking about tonight is that is traditional finance markets, and we're talking about crypto markets. The traditional finance markets do a great job of attempting to achieve 10% growth every year. Currently, we're on definitely a bit of a historic run when it comes to having a bull market in the S&P 500, but at the same time, there are times when there are downturns as well. 2008 financial crash, the dot-com bubble, and people don't really talk about this a whole lot. But recently, through the Biden administration, pretty much from the beginning of 2022, there was 2 years there where we had a net neutral market. And if anything, it actually decreased by about 25, 30-ish%. So if you are trying to just figure out the difference in that market and our market, well, I'll put it this way. I believe Bitcoin has already done effectively an 8x. And over the last bear market, it dumped about 78%. So the differences are pretty wild. So that's why we apply different strategy here. And
Zena,
it's also, yes, hit me.
What I wanted to elaborate on, and so I hear what you're saying. So yeah, a lot of times when you have your fund managed 401ks, it's basically you contribute out of your paycheck every 2 weeks. You invest
Mhm.
money. It's a time dollar cost averaging in. It's just a time basis. There's nothing else going to it. You just contribute. And it comes out of your paycheck every 2 weeks, and it goes in. And you kind of just forget about what's happening. The concept here though is, and a lot of fund managers will tell you can't time the market. Well, you can't necessarily time the market, but there's times when you probably need to be taking profits just to be a risk manager. And and TradFi does that too, as a risk, managing risk. And that's what their job is as well. So this is nothing more about trying to time the markets, but you're trying to take educated guess when the proper time to maybe take something off the table or to put it back on later on. And that's something that most people don't do because they're not proactive enough.
Correct. Exactly. So when it comes to crypto, I happen to believe that we can, with a reasonable degree of certainty, time the markets. There are some established patterns that we've talked about repeatedly on this channel, namely the Bitcoin 4-year cycle, and that also plays nicely into a lot of other cycles, whether it's the monetary cycle or the business cycle. The way that it lines up is that people that have been able to capture on this have had life-changing amounts of wealth transformation. So the goal here is that this is an emerging technology and market with I'll put it this way, crypto is the best performing asset class in human history, hands down, period. So it makes sense that we're willing to take the risk and go into this uncharted territory or barely charted territory and try to do something out of it. For the reference of the picture on screen, what I'm referring to is I'm referring to those drawdowns that we have in this market, which is that Bitcoin, which was the least dumping asset over the last cycle, dropped about 78%. That is not great. That's pretty much going from looking at $100,000 to looking at $22,000 at the end of all of it if you held all the way through. So that's why we get the analogy, bird in the hand is worth two in the bush. If your money is still in the markets, that's in the bush. If you actually have it taken out and you've taken profits, that's in the hand. And by the way, excellent shout out from our good friend Centurion54X. He says, don't take screenshots, take profits. I would be up 50K easy if I follow that advice. I am right there with you, sir. Believe me, we all have to learn these things the hard ways, but hopefully we can help some folks out there not do that, or at least not round trip it and eat the entire loss. Speaking of which, what are we not trying to do here? I just mentioned one of them, but can you give us the analogy of what that one is, Tracker?
Well, this is what crypto is all about, right? I mean, everybody treats it like it's a big casino. You come in here, and it's crazy to me when people come in here. It is straight up gambling. This is where you get your meme coins, you get your pump and dump schemes. Scams are all over the place, but in crypto, it's interesting. The concept for traditional TradFi, you're happy if you get 10, 20% returns in investments. And here, everyone's expecting that within a day, if not within a few hours. So they're chasing the gambling bug is what's going on. And typically it's going to get you wrecked. That's the short of it.
That's one of them. That's the gambling aspect. We're trying to be investors, not gamblers. What's the other one? Our little plane analogy there.
Oh, round tripping.
Round
Meaning
tripping.
a
Yes,
lot of
sir.
people, I mean, a lot of us are guilty of this one, especially in crypto. You got a lot of people caught at the top in 2021. Now everyone's round tripped all the way around to 2025, which means you didn't take any profits. You watched your portfolio grow dramatically. Everything looks looking great. You didn't take any profits, and then crypto crashed, and you lost most of it. And now here we are trying to come back up again, and it's a tough pill to swallow. The best thing to ever do is take some profits, take some wins, because when things go down, it's much easier to stomach, and you've got a better balanced portfolio. And guess what you have? You also now have fresh dry powder to DCA in at these much lower levels too. So that's another concept that people don't think about. So when you round trip, you're just sitting there. You've lost the opportunities.
Agreed. And I know for everyone sitting at home and even ourselves in the chairs here, you could think to yourself, how could I possibly round trip? I pay attention to these markets all the time. Why would I do something so foolish? Well, I think I have an answer for that one. That is our favorite here. We have the Wall Street cheat sheet, aka the psychology of a market cycle. This is going to help us explain how it's possible to round trip. So, Tracker, any thoughts to get us kicked off on this guy?
Well, I know we talked about this on Monday night, and we don't want to deviate too much, but keep this in mind. Some cryptos, tokens, some TradFi investments, and other markets might be in different categories all at the same time. They're not all, they don't all move together. Good example for TradFi folks. If you look at S&P and the Dow and the Nasdaq, it's been doing real well. The Russell 2000 has been lagging. So you could say, are we moving more into belief and thrill state for the S&P and maybe the Nasdaq, while the Russell is still in this optimism phase or belief phase possibly? So it might be lagging, but what you're looking at here is a classic example of, and keep in mind, you have two different sides of this. You have people that are very bullish and very bearish. So people that are really bullish are thinking one way, while other people that are bearish are thinking another. And guess what? Two different psychologies like that, you put two different groups together, and that's what forms a market.
There you go. Alrighty. Well, let's answer the question of how is it possible for anyone out there to round trip? Well, let's just go through the whole cycle here and see what's going on. Obviously, this chart is depicting an asset that has an excellent pump and then recorrects down to either original levels or a lower level. This tail end here doesn't have to be the same level as before it started. If anything, we've seen the crypto markets, it just creates higher lows as the cycles go on. So the right side of this chart, it will be higher than the left side of the chart initially, but let's start it off. Disbelief, believing that this rally will fail like the others. You see a little bit of a price movement towards the upside and then a small correct to the downside, and you're like, it's just a fake out, nothing's happening. But then it keeps going up, and that's where you see hope. A recovery is possible. The chart is going up. We might be able to break out of where we've been. Then we hit optimism when things start going up even more. This is where, all right, this rally is real. I feel it. At this point, you're probably investing, DCAing, throwing money into the market, watching it go up, watching numbers on your Coinbase account or your Fidelity account going up. Then we get belief. All right, time to get fully invested. This is where you go sell the motorcycle in the garage or whatever that you think is laying around and collecting dust and try to get some cash to put in there. Thrill, you are doing great. At this point, you're like, man, I've already sold the motorcycle. Maybe I got to go margin trade. I got to go get some sort of leverage to really capitalize on this. Is the real deal. And then we hit euphoria, aka the market top. At this point, everyone's thinking, I'm a genius. We're all going to be rich. Bitcoin's going to $1 million, going forever. Nothing could ever possibly happen. And then we get a small correction towards the downside. And then we get the famous dead cat bounce, but we don't know it yet. So are we as high as we once were? No, we're down like maybe 10, 20%, but it's like, it's okay. It's just a correction. It's just a correction. This is where we get complacency. You start saying things like, we got too hot too quick, had a small correction, but it's still going up, I swear. And then you watch it go down, down, down. Start getting some anxiety. You're like, my leverage trading is getting margin called. I'm losing out on these stuff. This dip is taking longer than I expected. Maybe I just need to double down harder. Because we hit that price, I thought we were going way higher. And then it keeps going down. Then you hit denial. My investments are great companies. Why aren't they working? These tokens are supposed to be the future. I thought Bitcoin's going to $1 million. What's going on? And then we get to panic. And at this point, everyone is selling out. And this is where we get a famous falling knife scenario, if you will, which is that it's compounding effects. One person sells, another guy sees that person is selling, so they sell. So now we have double the effect. Then more people see those guys are selling, so they sell, dropping price even further. And then the rest of the market figures out, oh, shoot, everybody's selling, and it's just going to keep on dumping. And at this point, we have capitulation. I'm getting 100% out of these markets. I can't afford to lose more. So maybe try buying that falling knife, and you just hurt yourself even more. And at this point, we get the final three, which is pretty much rock bottom. Anger, depression, and disbelief. Being like, what the heck's going on? Who did this? Who can I blame? I can't believe it's gone. Oh no, my 401k, my retirement money, it's all gone. I'm left with breadcrumbs. Granted, you're probably still up maybe like 5% based on your initial investment. But at this point, it's very possible you're actually in the red quite heavily as well. And there you go. That's the market psychology. Cracker, do you consider yourself a rational man, if you will?
Oh, but that's the thing, though. The markets, no matter how rational a person you are, the markets have nothing but time.
Bingo.
and
Correct.
they will wear
Correct.
you down. They will wear you down and grind you if you let them. And then just to piggyback off what you said, Zian, which is great, depiction of everything. Then you go back and it rinses all over again, disbelief, and then it just starts all back over again. And this which causes these markets to go up, go down, and frustration. Good example here though. So if you were to look at Bitcoin, how it ran from 2024 and how it hit out new highs, kept going up. Ethereum faked out and started going down. So this is what I was saying. If you compared Bitcoin and Ethereum, they were in two different phases of this. And not saying we've hit euphoria thrill, but I would say probably Bitcoin definitely, once it broke out to all-time highs, definitely the belief was in and the thrill was starting to really come into Bitcoin, while Ethereum was still stuck back in optimism maybe, or hope that it was going to finally break out. And then when it finally touched the all-time high, it was like that's when the optimism kicked in. But now we're kind of getting tested again to say, okay, are we going to actually get back to and really get to that belief or thrill to what we could see in Ethereum? So that's what I'm saying. Different things, different token, and same thing with Solana. Solana moved with Bitcoin as well. So those are the only two that were really shiny cryptos over the last 2024 and most of 2025. Well, certainly 2024, maybe not 2025, but you guys get what I'm saying. Things are coming in different phases.
That's true. They definitely come in different phases, but there is a little bit of correlation. Like when Bitcoin runs pretty hard, especially like the first time as we saw this market after the ETF launch, we saw a lot of altcoins, layer ones, some like gimmick plays, like a little bit of GameFi, a little bit of AI tokens, that kind of stuff. They all just climbed with it. And then those ones dumped harder than Bitcoin. And then Bitcoin's been slowly climbing back up there. But all the other ones, most of them anyways, have just been bleeding down into the right. So it's possible to get correlation. It's not. But the moral of this story is the famous quote, which is that the market can stay crazy longer than you can stay solvent. Meaning, if you're doing the crazy stuff like margin trading and the market's doing crazy stuff, the market can do crazy stuff for longer than you can hold off those margin calls. And by the way, this chart is not to scale, by the way, nor does it go in this cycle exactly. You could easily go from anger to depression, back to anger, back to depression, maybe disbelief, then back to anger. It's entirely possible. Alrighty. Well, let's get it going here. So let's look at an example of how this might have happened in real life. Round tripping, if you will. So what I have here for you is the Ethereum 2021 chart. You might look at this and be like, wow, this is a great chart. We went all the way from about like $80 to $4,500 effectively, or $4,900. That sounds like a great chart to me. Yeah, it is if you can capitalize on those gains. But let's be real here. Who's buying exact bottoms and selling exact tops? The answer is no. No one is. So quick analysis of the chart. First all-time high was 4,900. Our first low directly after it, that first drop down, that got all the way down to 2,175. Keep in mind, this is a logarithmic chart, so every doubling in the price is a 10x effectively. For every section you move up is a 10x effectively, or a 2x based on how far you're measuring. So it's not linear is the point. So yeah, from the bottom to the top, or even from the bottom to the first pump, that's really going from like $100 to like $250. But going from the top to that first drop, that is pretty much like 50%. That's $2,000 plus. After that, we have our famous dead cat bounce. We got all the way up to 3,500. And then we went all the way down to our bear market low of $900. So again, it's very easy to look at this chart and be like, why would I would know better? Because, well, I would argue the answer is you can see the back end of the chart. Let's see what might actually be going on here. All right. Zooming in on Ethereum a little bit, and we're going to give our side-by-side comparison. So, tracker, that first arrow all the way on the left side, if you had to grade that on the psychological chart, what would you call that point?
Well, I'd have to look at the Ethereum price chart before then. But, I mean, if we're just going to overlay this, I mean, yeah, that first probably around hope.
Yep, there you go. I might even call it optimism even. What's our next one? There where we have our first correction for a higher low there.
It's got to be somewhere in the belief, probably the belief, because I don't think it's quite up at the thrill phase yet. I feel like the third one's probably thrill, and then of course euphoria is the fourth one.
There you go. Well, I would agree with all those.
These line up really nicely with the chart. These line
that
up
they do. All right, so our fifth one there, our first new lower high.
Complacency. Yep. This is when you think like, oh, we're just having a little pullback. We're going to break out. And then it gets rejected. And then that's typically what happens in a lot of these. That you see these immediate drops quickly, and that's the flush. And institutions love to do this, or people like to do this. So when you get this drop, if it can't make the new higher high and it gets rejected, that is a time to be worried. So from a psychology standpoint, you can see where the consolidation happened at the bottom between arrows 4 and 5 right there. Once it broke down that support line there, it was a free fall down. We've seen scenarios where it's done the same thing. It could have found another support, but it basically at that point, people were taking profits because it had already had major profits. So that's what you're seeing. People are taking profits, and then people who are panicking, they're getting out. So it's a trickle effect. It's a snowball effect essentially.
Agreed. There you go. I'm just saying the charts line up pretty well. And if you really take a step back and you take it with a grain of salt, I think you can easily understand how a lot of people could be very prone to falling into the market psychology chart in even for this one, which Ethereum 2021, that was a good cycle. That was a very good cycle. I'm not going to lie. But at the same time, though, there's definitely some people that lost out on it. Yes, at the same time, if you bought the low and then you look at your next bear market low, the low for Ethereum was like $80, and then the next low was like $800. So it's still a 10x, but you're still down 80%. So instead of having like, I don't know, probably close to like an 80x, you have like a 15x or something.
But the big piece you're missing though, that you're not missing, but people might miss is if you would have even just taken 20 or 30% of your portfolio towards the top and taken it off, you'd been sitting in a really nice big pile of cash. So as this, and I knew you're going to get into the DCA concept. So now it's a much more easier pill to swallow because now you got some capital to inject at lower prices as it pulls back and gets lower. And that goes into the concept buying low and selling high.
There you go. Alrighty, let's get after it. So, let's see. A very popular idea these days is, I don't know, maybe becoming like Michael Saylor, which is just buying Bitcoin forever and never selling. Well, theoretically, wouldn't that solve the issue of the round tripping thing? Or like, I mean, the chart's only going up and to the right. Why not, right? What do you think?
I don't know, but it's tripping me out, man. I used to have this exact same chessboard. It was actually handcrafted out of Germany, believe it or not. That's just kind of blowing my mind. That is the exact same chessboard. That's crazy. Interesting. Sorry to deter from the material. But diamond hands never selling. Basically, it's the same concept of 401ks. Most people they just hold and hold and hold, and they don't ever sell. Or the diamond hands where they're not going to sell for a much longer time until they're in ridiculous amounts of profit for they'll finally take out. Our man here, who's the Bitcoin king with MicroStrategy, Michael Saylor here, it's funny because he was totally against Bitcoin when it first came out. When it was out there, he was bad mouthing and everything. So now he's the biggest, cheerleader for it. And his company, MicroStrategies, does time DCAs to where they're constantly throwing more money, buying more, and accumulating. Now they're all in with it. They're even doing a lot of other things with it. I'm not trying to deviate from this, but they're diamond hands. I mean, they're thinking, I'm just accumulating. They're not even thinking about selling. They just want more and more and more and more. So their strategy is more like, I'm looking 10, 20, 30 years out. That's typically diamond hand, folks. The long-term investor.
Absolutely. The pros of doing the diamond hand model is that you don't have to worry about timing the market. You just get in and stay in, and you're just going to watch the net worth grow effectively, assuming you're in a good asset, or if you're just doing the S&P 500 thing, you're going to grow money over time. It is effectively compounding interest at its best. And with Bitcoin, like Michael Saylor, there are people that have done very, very well with this kind of strategy because it's just gone so up and to the right for a good chunk of time now. Like this man is up like $80 billion or something crazy like that, and he's never sold once. And he's still buying at the tops. So like, why does he need to concern himself with timing the market? I mean, it sounds like he's doing pretty well for himself.
Well, he would be doing even more well if he would have taken something off when things get very high or low, but he's not thinking like that. He's thinking that this is such an undervalued asset that he doesn't care about the short-term few years here, up and downs. He doesn't care. He just wants to keep accumulating because he's looking much further out to what we certainly buy into the narrative, But if people are buying into this is going to be just the massive accumulation over the years, then keeping in mind the crypto market's only was it 4 point was it not even 4, it's not even 4 trillion anymore. It was at 4 trillion. I don't know where we are right now, but we're flirting around there. Let's just say 4 trillion. The gold market's at 25 trillion. Just to put it in perspective, the traditional TradFi S&P 500 or something, I think it's 100 trillion. So you can see how small the crypto market is. If it truly is going to be this, revolutionary change to the financial institutions, or people accumulating to be digital gold, then there's so much more upside to the long-term holder. So if you have that kind of mindset, you're not looking at it from a trading standpoint. But here's the thing: we're not all Michael Saylor. We don't have this kind of cash floating around. We are
Correct.
we would love to build that kind of a massive pile of funds, but we have to be a little more proactive if we're going to get there. So I think the best way to think about it is, how much money do you want? How much do you want to make? How much are you working with? So the least you're working with, the more harder you have to work at it and be more strategic with your plays. If you're a big whale and you're sitting on, millions of dollars plus, and you can invest these into various assets, then you have that luxury of time. Because if you're worth 20 million or plus, let's just say you're doing really well off, your lifestyle is not going to change. So you have nothing but time to keep this stuff invested. If you're not in such a great case, then you have to be more proactive. That's basically what it comes down to.
Exactly. And here is where we've reached the first big fork in the road. We are not Michael Saylor. We are in different leagues. I'm not going to speak for you on this one, but I can tell you I am not a millionaire. And I definitely don't have $20 million plus in a bank account or investment accounts that I can use to compound growth. If anything, I am probably more along the lines of someone that Alex Ramosi wrote the book $100 million offers for, which is you want to be rich, and theoretically, you only need to get rich once. After that, then it's about protecting and then slowly growing the wealth instead of trying to get that rapid accumulation. If you follow the models about the exponential growth of compounding interest, you'll know that pretty much the majority of the gains come in the last 10% of whatever your time frame is. It's going to the idea, very well-used quote, is that everything kind of explodes after $100,000. So, well, let's assume you don't even have $100,000. It means we're going to be looking to get there. So, buying and holding, never selling, sure, it works if you're trying to use a solid asset to slowly gain and beat inflation. But at the same time, though, if you're looking for real investments to, get up there, which I would argue a lot of folks in crypto are doing, you might have to take a different approach. Alrighty. Tell you what, let's get into the fun stuff. I have been crunching some numbers today, and I present to you my case of why I want to be something other than Michael Saylor. So, here we go. Starting off. Say, cool, but you're not that guy. You're not Michael Saylor. So, never sell strategy. Mindset is things only going up and to the right. You want to minimize risk and the amount of actions you have to take. You're going to be buying routinely, and you're not planning to sell. You just want to watch that number in the account go up. So, let's run a base model here. So let's say that you invested $100 every week at the market close. Let's just give a starting date of May 2nd. I picked this one because May 2nd is about halfway. Sorry, that's supposed to say 2022. My bad. That's pretty much halfway between the all-time high and the bear market low. If you invested $100 every week to current week, you would have invested for 178 weeks. That is $17,800. 3 years and 5 months. Your current value of the Bitcoin that you would have from that is about $53,387. That's pretty much a 3x, 200% gain there. So let's see. That's what that looks like. So the blue line is our Bitcoin price. The orange line is the total amount of money you have put into the system. And that gray line, that is what your portfolio is worth. So we go all the way from the May 2nd, 2022 to today, which is now October of 2025. You can see that your portfolio has done pretty well. There's a high degree of correlation with Bitcoin, obviously, because we're just using a single asset for this examination. But at the same time, the things to note is that your highs are not as high, but your lows is not as low. Because what the DCA does is that it smooths out those periods. And in general, if the asset goes up and to the right, guess what? Your investments are also going up and to the right. So let's talk about the different approach, aka trying to buy low and sell high. Well, We're also going to make two more assumptions on this one. We're going to assume that we're imperfect people and that we are incapable of buying the perfect bottom and selling the perfect top. So the mindset here is that we have accepted some reality and some risk, which is that the reality is that, well, things are going to crash and we hope to capitalize on that. And that's part of it. The risk is that we don't know when the top is exactly. So that's why we have the 80%, the double 80% efficiencies, if you will. And if you're in this mindset, odds are you're probably operating off the 4-year cycle. So it's held true for the last 3. What's one more, right? So with that being said, we're going to assume our average buy or sell is 80% of the best price we have, or based on the movement down or movement upwards. So starting off May 2nd, 2022, total of $17,800. We'll just carry that over from the last scenario. Let's just say we dump that all in the market at one time. Is this realistic? No. This is why this is the bad math section first. So full investment of $17,800 at 80% of the price drop would mean that you bought in at $26,860 when Bitcoin went from $69,500 all the way down to about $15,700. All right. Again, we have to do some imperfect math additionally. And well, we had a recent Bitcoin high of about $125,000. So we're just going to assume that that is the top of the market and roll it down from here. If you operate off the 4-year model, that's actually pretty accurate because we're pretty much like 3 years and 11 months since the last all-time high. So that's not too terrible. All right. So we bought at $26,860 and we've now sold at $103,000, 140. Our final value is $68,350, or a 380% gain. That is higher than our 200% gain in the DCA model. So at the same time, it's like, all right, that's good. But again, this is the bad math. Keep that in mind. You're not doing this. And it also is a very unfair comparison because it's saying you put in $100 a week for pretty much 4 years, as opposed to I have 17 grand and I'm going to invest it basically perfectly at the market bottom. You can't really do that, but we can try to make this more fair and we can get close. Let's do some good math. All right, let's take that 17,000 and let's split it in half. We'll say that we weren't DCAing the full time. We maybe have a little more cash that we're willing to front now. So we're pretty much going to start off with about $8,700. We're going to take that $8,700 and we're going to put it in at the entry price of $26,000. And then from there, we're going to do weekly DCAs starting from here until now the time that we sell. So the time that Bitcoin hit this price target was the 13th of March, 2023. We're going to carry this until we sell, where it reaches that sell price at 103,000, which happens on the 2nd of December, 2024. So the initial stack value, that 8,700, is now worth 34,175. Again, we're mirroring the 383% gain. The DCA value, we've also cut that in half, so it's only $50 a week now. Well, this is the shorter time frame as well, because remember, this is pretty much happening almost a year before today, which we're talking about in October of 2025. So you would have put in $4,500 and you would have had 143% gain for a total of $11,100. If we combine all of our numbers together, that means you were in for $13,200 and you were out for $45,275, or a 342% gain. You might notice that that total out is lower than your total out for the other method of never selling, or in that case, it's not out, but it's what it's worth currently. Let's continue. Here's what our hybrid model looks like. Again, keep in mind, this is a slightly different time frame. So we have 2023 here because before this, it's just a flat line of 0. So now we start off at $8,750 because we're assuming the initial investment and the starting of the DCA. We're going to carry this through until we sell. And again, we very much mirror the Bitcoin price here. The difference is we just kind of start at a different point. But again, same effect. Lower lows, lower highs pretty much. So that being said, our final comparison here. Well, if you never sold and you took the Michael Saylor approach, you would have put in $17,800 and you would have ended up with $53,387. If you would have done this semi-accurate hybrid model, you would have invested $8,700 and $4,500 for a total of about $13,000, and you would have been out for $45,000. So at a glance, you might be looking at me and saying, Zenith, what the hell are you talking about? Why don't we just be Michael Saylor? Well, I may have left out one tiny detail that might be important here. That is the drawdown. Because remember, you get the ups, So you also get the downs. So our never sell DCA ended up at 53,387 and the hybrid ended up at 45,000. Let's see how they do in the bear market. And by the way, this is hypothesizing into the future, assuming previous trends hold and we have a bit of a logarithmic decay curve for the amount of percentage that the Bitcoin is going to drop. Basically, the older Bitcoin gets, the less it drops during each cycle. So previously, we're at 78% down. So we're going to assume a 70% down this time. Assuming 70% down, that means our next low, also using the 4-year cycle here, is going to occur on the 21st of October, 2026. And its price is going to be about $37,500. Our never sell model, aka the Michael Saylor model, because they held through this entire thing, or you round tripped it, this means that you're eating the losses. The hybrid model instead, it's going to A, catch up, and we're going to try to make it more fair by equating the amount of money total in, and instead of DCAing, it's going to be buying dry powder or just storing money in the bank, getting ready to buy it in the next point. Now, at this point, the never sell DCA model, the Michael Saylor strategy, they've DCA'd 55 times. It has been 55 weeks since we ended our last analysis. Your average DCA price is $75,000. Well, that means that your new total of Bitcoin that you own is 0.5494 Bitcoin. There's some extra numbers there, but I rounded up even to be nice. And I also adjusted the DCA slightly down from the midpoint to account for maybe a faster drop and more time at the bottom there. This means that you have currently in your account $20,000, $605. You have invested a total of $23,300. You are technically in the red at this point. But if we go over to the hybrid model, you are not in the red. Your dry powder, your weekly DCAs effectively, the entire time that the never sell model, the Michael Saylor, was buying, you were just putting that into the bank. Additionally, we've given you $4,600 to catch up so that you have invested the total in the same amount of $23,300. The amount of money that you have available to deploy at this time is now $59,575. That is the difference between these two models. If you take into the full trip, both up and down, if you are able, even imperfectly able, that means that at this point, you effectively have tripled the stack of the other model, meaning that buy low, sell high has now 3 times ahead of where Michael Saylor would be at that point had you had the same amount of money to invest, but just implemented those different strategies. Cracker, what's your initial take on that?
Well, first of all, good job on running all that data because he took real data and he actually plugged all this in so you could see by stacking these two different types of strategies together what it would have actually came out to be. So you can actually see and, what strategies what does it tell us? Now, if Bitcoin truly does start to take over and we have mass adoption and it just keeps going up, then yeah, the never selling is going to absolutely crush. Unfortunately, crypto is still being treated as a risk on, risk off asset. Right now, we're entering a risk on asset at the time. So with Fed cutting rates and so forth, quantitative easing potentially all these things, right? More liquidity helps smaller companies, thus people have more money to put more towards riskier assets. If that's the case, then crypto is going to do very well. But when that risk off occurs and we go into a bear market, bull and bear markets don't last forever. They go up, they go down. There's a lot of different things that cause this to happen. And so most likely you're going to have pullbacks in crypto when risk off kicks in. So I don't predict Bitcoin and Ethereum just keep going up forever. It's just, I just don't see it happening. Sorry. So if you take that strategy, you will absolutely be able to take some profits off and you'll be able to stomach those downturns too, because it's brutal to watch those sell-offs and you didn't take any profits and you've been just adding. It's a very, very, very depressing process you do not want to go through. You always want to at least take something off the table. I don't care if it's 20%, 30, 40% of your portfolio, something. So when those pullbacks come in, like you have this dry powder, like you stated, you'll be able to inject it at much lower levels or times in the market where it is screaming by when things are just way exacerbated to the downside and well oversold. Crypto, you have on-chain data that can tell you these points when it's time to really get in. I know in Q4 of 2022, indicators in Q4 were screaming that we were at all-time levels to start just throwing everything you can at the market at buying low levels. So there's things like that that give you good indicators. You'll see indicators in traditional markets too when things start to bottom out. There's a lot of indicators that can help you determine that. We do that a lot here to try to help and not to try to do daily trading and things like that as frequently, but this is long-term strategy. So it's much easier to, and that's the other thing. It's easier to pick bottoms than it is tops. That's typically the rule of thumb.
By far.
So yeah. So when you see these levels where you want to have dry powder to be able to put that investments that you took off and reinvest them in, and you'll see it compound, and it will work out over the long haul for you. It will. Just holding, it's like I said, it's, and that's the other thing you got to think about. Traditional markets, you as an investor in the traditional markets, you can kind of get away with that in traditional markets because you're down. What's your pullbacks? 20-30%. Those are massive pullbacks in the markets. Those are like 2008 financial crisis type scenarios where people are freaking out because they've lost 40% of their portfolios, maybe 50%. And crypto, that's every 4 years. More than that, it's like 70%, 80% of your portfolio downturns. So that's why everybody always makes a joke in crypto that 1 year in crypto is like a decade in traditional markets because everything moves so much more quicker. It's so much of a volatile asset, and that's because it's still in its infinite stage. It hasn't matured like these other traditional markets have been around, and that's why. So the long story here is you definitely want to build up dry powder for those really bad times, because if you don't have any dry powder and you've been all invested and you watch it go down, like I said, it's a bad place to be.
Oh yeah. And by the way, the simulation that we ran here, this is an imperfect simulation, not in the way that you think, but because it assumes that the Bitcoin all-time high is already in, which Tracker, do you believe that the Bitcoin all-time high for this cycle is in yet?
I'll say it this way. I don't think risk on assets have truly kicked in yet. So thus there hasn't been euphoria, and that's not just for crypto. That's for the small caps in the TradFi world and all these other assets that people can invest in. So I don't think anything is in yet, period. And with all the quantitative easing, the rate cuts. First of all, let's talk rate cut. Rate cuts are coming. So basically, long story short, I'm not going to get into all that, but basically there is a path greased and a very clear path to tell you that money injected into the market is coming, and it's going to be more aggressive. If you believe that, and you believe that that can stem also the financial market, or the labor markets, I should say, if you believe that narrative, then yes, we have more room to run in the risk on assets, and crypto certainly is in that category. I am personally in that category.
I'm right in that camp with you. I think so as well. So if we take that assumption, we apply it to this scenario, that means that the hybrid model actually is going to make more money than this. Granted, it won't have as long to DCA, but that can just factor into the catch-up method there, which even means you're going to have more time to DCA into getting more all-time high. So this is a low projection for the comparison that we ran here. And additionally, it doesn't even take into account things like this green candle right here, this big one. That's where you entered the market initially, and then you DCA after that. We spent effectively 9 months below that price. So it's very possible to suggest that your downwards trajectory for price entry could also be lower, meaning more gains as well. So the reason that we're bringing this up is it's kind of the justification, or the argument, if you will, as to why there is a tremendous amount of upside progress to be made using the strategy of trying to buy low and sell high, even if you have imperfect data and imperfect entry and exit. You are still, like, by the numbers, at worst, like 3 times ahead of the people that just buy and hold it forever. Granted, the people that buy and hold it forever will be massively in profit at many points, but there's also going to be times where the drawdown, and just because you're DCAing in at a weekly basis, means you are going to capture lows and you are going to capture highs, meaning your average price is going to be a little bit higher than if you're trying to do the perfect buy low, sell high. But at the same time, DCAing does have its merits. There's absolutely something to be said about spreading out the risk across these assets when we're already in an inherently risky world. So because of all that, if you're trying to get to 20 million and you're trying to get past that 100,000 mark, I think that if you're willing to take on the risk and you're willing to accept the responsibility that all that entails, The upsides are tremendous. They're just absolutely tremendous.
Yeah, just sort of, I mean, if anybody doesn't believe this, do a comparison between the gold and Bitcoin chart or the gold and the Ethereum chart and see how much it has absolutely destroyed gold return on investment, even with the hard dips down and these pullbacks at which we're trying to tell you to also try to capture it. And we're not trying to tell you to time this to where you're trying to do trading every month or every week, but maybe look at it from a quarterly standpoint. But really, there's tons of we talk about this in our groups. There's tons of technical indicators, on-chain data. There's a lot of things that tell you when you're probably at a local at a short-term high. Maybe it's time to take a little bit off, maybe 5 or 10% of your portfolio, and then if it pulls back, at least you have something to protect yourself to the downside. But markets go up, go down. If anybody tells you markets go straight up or down, then they surely do not know what a market is. Because, I mean, what do you think the people, when they were living in the Roaring '20s, they thought nothing could ever go down, right? And then the Great Depression kicked in the '30s. And that cycle just keeps coming. And there's actually a chart out there. There's a time when to sell, time to make money, time. There's this concept that's been actually it's eerily, it timed it very well over the last 100 years. So markets go up and down, and that's not some crazy, but that comes down to liquidity being injected into the markets. That's how governments do various leverage that they pull that will inject more capital into the market. Invest more capital, more lending. If more lending, more spending, more buying, and these flows kind of occur roughly every 4 years. So things go up, things go down, and it's not because it's just the way we live. Most people don't pay attention to those kind of things. The other thing is you could
Real
always
quick,
take a
is this your
there
card?
it is. There you are.
By
So
the way, this is called the Benner cycle. What this is, if you have studied wave theory at all when it comes to physics and stuff, it's the idea of compounding or conflicting waves. If you have two waves that come together at peaks, they'll amplify. If you have them come together kind of like at an off time, they'll average out. If they come together at the bottom point, they'll amplify negative. And that's pretty much what this is.
yeah, it's a fascinating concept, and if you line up the years and all, it's kind of it's definitely it definitely is pretty damn close. That's all I'll say. But you could take two different strategies here too. Let's say you have a 401k. Maybe you treat your 401k as more of a long term, because you're not going to be able to touch that anytime soon. So you could maybe put that in long term, maybe DCA into that. But even then, if you're just a little proactive, maybe instead of when you do your contributions, I mean, to each their own. But for me, if I'm doing any contributions in a 401k, at least I used to do it back in the day when I contributed, I would just keep putting into a money market account, which is essentially just putting in cash. And then when those opportunities came in, then I deployed it. DCA'd it using that strategy. And then when things got to high, pull it out, moving into the money market account to kind of stick to the side. So you can do the same thing in a traditional market. But what I'm saying is your longer term horizon in a financial or a traditional retirement fund, you have nothing but time. So you can kind of take your time, and you might be looking at that. Maybe look at it every 6 months, every year, or kind of look at that. And then maybe if you're doing in crypto, maybe you're a little more proactive. Maybe you're looking at this maybe at every month, or you're looking at, because crypto will move. When it starts to move, it rips fast. So you got to be much more proactive. So this, like we talked about, 1 year in crypto is like a decade in traditional markets. So you've got to be a little bit more alert on what you are. And even if you're in Bitcoin, which is the slowest moving one because it's the biggest one out there, it's even then it has, compared to traditional markets, it moves much more aggressively. And that's the largest one. So
agreed. To that point, crypto moves fast. For reference, this is the Bitcoin price in 2021, early 2021, even before the top. This little window right here, these 3 candles, this is a weekly scale, by the way. In 3 weeks, the price went from 33,000 to 57,000. That is effectively a 2x in the quarter of 3 weeks for the largest market cap asset out there in the crypto space. This moves fast, and this is the slowest moving crypto asset that there is.
To put that in perspective, that would be like something, it's kind of a bad analogy, because in the traditional markets, the large tech companies tend to be the largest cap companies that make up most of the S&P 500, but it would be something like one of those stocks moving a 2x in a 3-week time span, which would be
the traditional calculation for that one is that assuming 10% growth annually and compounding interest. So what Bitcoin did in those 3 weeks, it would take traditional finance at 10% annual. It would take them 7 years.
There you go.
Just saying.
There you go. Yeah. So things move very quickly in the crypto world. So
For sure.
that's why this DCA and taking some profits and things like that is very much beneficial to you in the crypto world, unlike in the traditional markets where it moves much slower. So if you get things wrong, it's not really going to be detrimental. And on a side note, just remember, what's the traditional market's return on investments every year? What is it? Like 9%,
Allegedly
8%?
it's 10%, but if you account for pretty much the last 30 years instead of the last 60 or 70, it's closer to 8%.
Okay, so 8%. Well, I hate to be the bearer of bad news for everybody, but we're pretty much at 8% inflation annually. So that's the dirty secret nobody wants to tell you about. So they'll tell you it's 3%, whatever it is. Now it's more like 8 or 9% inflation. That's why you're getting these quote unquote returns in the market. You're really not. It's just hedging against inflation. It's just people haven't woken up to that yet, unfortunately.
Yeah. The reason behind that is that the way that the government anyway calculates inflation is they love core inflation, which excludes some of the most volatile things like food and energy and doesn't take into account house prices. Those are the ones that really have gone up very, very much over the last like 40, 50 years. I want to say that like a house back in the 70s was probably like 40K. Today, that same house probably is worth like $320,000. That's a factor of 8. That's pretty much saying that over the course of 50 years, you've done, what is that, 900% or something like that? So the bad math says that that's about like 9% or gosh, 9,000 divided by 50, 900 divided by 5. It's at least 20% a year. I'll say that much. And that's for asset prices like houses, which, by the way, do we need a house to live? Last time I checked.
I mean, you can get an apartment if you had to, but I prefer to get a house personally. But
Yeah.
Well, guess what we're telling you is we did a course on this on Crypto 101. And for those who haven't seen it, I highly recommend you go watch it because we really dove into this and showed you the history of the money, explained inflation, and also talk really about what's inflated just since 1990. And the things that you really need to live have exploded. Your food, education, housing, medical, the things that you are necessities, things like TVs, digital equipment, stuff like that have really kind of just been the same, haven't really gone up, but they sell your data, by the way. So that's how they're able to suppress those prices on those gadgets. But that's here nor there. But we recommend you go watching it. There's a lot of good information. Put a lot of time into that. I think once people realize and see that, it'll definitely hit home on what we're trying to explain right now.
Definitely. Well, I think we gave a good case of why you should take profits. It definitely seems like a very advantageous strategy, but there are some additional things to take in consideration about when you should take profits. Namely, it's going to be, is your profit taking strategy based on time? Is it based on price? Could you get fancy with technical analysis and Fibonacci levels? Yeah, you could do all of that. And by the way, we only looked at Bitcoin, which is allegedly the least gaining asset out of everything, of the things that do well and perform well, meaning that there's an entire plethora of other options out there, whether it's Ethereum, Solana, AVAX, maybe an AI token like Render or Fetch AI, or even some lower cap stuff. And if you want to get even a little degenerate, yeah, you could look at some meme coins. Crazy to say, but Dogecoin is actually the 4th token with an ETF. So if you want to go by that metric, it's the number 4 token and beats out many other ones that are still awaiting ETF approval or even a submission for an ETF. So by that token, yeah, there's a lot of different ways you can look into that. But I do apologize. We're not going to be covering that part on the stream. We are going to be saving that juicy little bit for our excellent members over at Walk the Block, which, by the way, if you wanted to join that, head on over to our website, walktheblockndf.com. That's where you can find the membership tab. Under there, you can also hit the join button. That will get you into our Telegram. You'll get access to all of our exclusive live streams going on over there multiple times a week, and our excellent chat where we post a lot of data, have good conversations, and discuss everything going on. So, folks, we like to say that the waters get rough, so don't sail through them alone. Come join us as we navigate digital finance together. Private mentorship, exclusive live streams, Q&A. Go from beginner to intermediate to expert with us. When we all work together, we all win together. There's plenty of room on this ship, baby.
And I would like to tell everybody, yeah, we do recommend you. We've kind of forced people to have a Telegram handle, but we give you a link to the Telegram company where you can set up your own Telegram account, because that's how we do all of our communications on Telegram with our groups outside of YouTube here. We like it because it's just a tool we've all kind of custom, believe it or not. But in crypto world, a lot of people like to use Telegram, Discord, things of those nature tend to be the more platforms that are used. So if you're not familiar with Telegram, it's all it is a messaging, but it allows you to have different groups and things where you can share stuff. And so don't panic if you've never been a part of Telegram or any type of media. It's pretty simplistic. It really is. And we give you the direct link to the company so you can see for yourself. So when you set up a Telegram handle, once you do that, you can sign right up. It's that simple. If you have any problems, just always reach out to us too on the website as well.
It's true. We're available pretty close to 24/7. We got a few different time zones, but apologies to the people in the Eastern Hemisphere. We are US based, but that's what we got. Alrighty, Tracker, before we head on over to Telegram, any final thoughts?
I guess the biggest one is pay a little closer attention to crypto right now. The government's making some moves. I know people are freaking out about the government shutdown. All right, personally, I'm not really concerned about that right now. And it's funny because crypto's been rallying since those news have occurred. So it tells you a lot. And gold obviously has been ripping higher. I would
S&P
say
500 all-time high as well, by the way, during the government shutdown.
Yeah, exactly. So, and this isn't the first time governments have shut down so many times. It's kind of been lost track. So I would say pay close attention to the crypto markets. And right now, the big caveat is that the big division in between crypto is, do we think that it's going to be sell the 4-year cycle, which meaning after, October, November, maybe even December, that's the end of it. It's going to sell off, while the other camp thinks we're going to keep extending into 2026. That is to be determined. So me personally, if we get some nice rallies going on here in October, November, I will certainly be doing what Zenith had presented everybody and taking something off the table, whether it's the top or a local top, then I'll still be okay because I'll have fresh powder to redeploy. So use that strategy now. It's coming up. You're going to want to probably apply this pretty soon, over the next month or two. So just watch crypto markets carefully.
Love to hear it. Alrighty, folks. I am Zenith. You can find me on X and Instagram at ZenithDI, but more importantly, you can find us in the Telegram, which we are going into directly after this. We're going to be talking about top indicators, going to be talking about different time frames and different strategies about, are you taking profits based on price, maybe performance? Who knows? But we're going to be talking about all of that shortly. So we look forward to seeing all you guys over there. Outside of that, everyone on YouTube, thank you so much for tuning into the special or catching it on the replay. If you have any questions, go ahead and leave them in the comments. We'll try to get to as many as we possibly can. We appreciate you guys' time, but more importantly, we will catch you guys soon in the Telegram. Till then, or if we don't see you, good night, folks.